Hi, Peter. How are you?
Good. How you doing?
You. Good.
Great.
How are you, Pete?
Good. Thanks for having me.
Thanks for coming back. So great time to have you with all these parabolic moves happening in different bourses across the globe. And why don't we start with the most extended? And I'm interested in what your thoughts are on the Nikkei being the most parabolic, almost looks like Bitcoin to me. And your thoughts of the BOJ being a participant in buying shares. So why don't we start with the Nikkei, and what's your take?
Yeah, I mean that's certainly that's been the case for the last couple of years. But I look at the Nikkei more as just playing catch up to the rest of the world. I mean, up until 2 months ago, the Nikkei was essentially flat on the year. So
right.
So the thing with Japan is, corporate Japan, we're seeing high returns on equity, improved governance, stock buybacks, dividends. They're beginning to do what most other countries and companies have done, for years now. So I look at Japan as just really playing catch up, but obviously certainly juiced by what the Bank of Japan has done. There's no question about that. But again, up until 2 months ago, I think the Nikkei was basically flat on the year.
Okay, so that's a good point, and Blake showed a long-term chart from the highs in '89, and we're probably at halfway back, 61.8 back after losing 80% of its value from that peak. So maybe it's a last hurrah, and it's really this whole thing that looks spectacular on a longer-term basis could still be called the bear market rally. You think I know you're more positive emerging markets, and definitely Japan is not emerging, is it?
Yeah, well, I think Japan is, Japanese stocks are going to be a beneficiary of problems that the Bank of Japan is going to face. I mean, if you're living in Japan and you have savings, well, do you want that savings to be in yen? Do you want that savings to be in a 10-year JGB yielding 4 basis points? You maybe out of pure defense may want that to be in Japanese stocks.
So it's Tina over there as well. There's
always an alternative, but I just think from a preservation of capital standpoint on a real basis, people may just choose to own Japanese stocks just to protect themselves.
Okay. So why don't we move a little further north from Japan? And I'm looking at your blog right here, Peter, and you gave a thumbs up to the PBOC's governor talking about leverage and that he's being realistic, which is unusual from what you hear from a lot of central bankers. What's the gist of this article if I clicked read more?
Well, if you listen to Mario Draghi and Kuroda and Janet Yellen and Bernanke before, there's no such thing as an unintended consequence of what they've done. Everything has a purpose in their eyes, and everything they do is for the better. And we obviously know that's not the case. And to hear the head of the People's Bank of China basically come out and say, there are major unintended consequences. We do have a major and dangerous buildup of debt and malinvestment and inefficiencies, and it's refreshing to hear a central banker talk about that. Now, what can be done about that?
Can you walk the talk? Can you walk the talk? Easier to talk the talk, right?
Right, exactly. And in China, it's not as easy to walk that talk, of course. But it was refreshing to hear a central banker. And it reminded me of what we heard from the ex-Reserve Bank of India central banker, who seemed to be ahead of the curve in acknowledging the major buildup in risks that we saw in 2006, 2007, when he spoke in front of other U.S. officials and said that we have a major bubble on our hands, and you better watch out. And Larry Summers laughed at him. So again, what comes of that out of China doesn't necessarily mean anything, but acknowledging that you have a problem is the first step to dealing with it.
Exactly. So China no longer in denial. How about Powell? What are your outlooks for the new Fed chair here? Same as it ever was.
Powell is just a repeat of Yellen. You know, he voted for all the QEs. He voted for zero interest rates. He voted to keep them there for 7 years. In a way, he's almost just a figurehead. I mean, I think that no matter who's in that seat has an extraordinary job ahead of them in that shrinking the balance sheet and continuing to raise interest rates is only going to end in one way, and that's a recession and a bear market. I don't care who's in that seat. So he's just a replay of Yellen.
Are you saying you wouldn't want the job, Peter, if it was offered to you?
Oh, I would take the job, but I would be honest. I would say, listen, guys, it's time for a recession or a bear market because it's going to happen inevitably, and it's better to get it over with sooner rather than later. It's better to do it now with asset prices at this level rather than blowing that bump even further into the future.
And wouldn't it be better politically for the president to get it out of the way, so perhaps at least the worst is behind us and we're coming out of it, going into his re-election cycle?
Sort of a Volcker type mentality, but
right.
No president politically wants to preside over that, and certainly Donald Trump, who talks about the stock market every day, doesn't want to see a bear market when he keeps tweeting every couple of days about the record highs that we're seeing. So it was almost obvious that it was going to be Yellen or Powell. I mean, this dance around Warsh and Taylor, that was just an optics game, because there's no way that they would cede power to a central banker that doesn't believe in near zero interest rates and doesn't believe in QE.
So if Powell is the figurehead, where's the power on the Fed? And do you see anyone that could sway the Board of Governors to finally, address these emergency levels and begin to withdraw the balance sheet and take the risk that asset prices may fall? Is there any voice on the Fed that could hold sway over Powell?
No, and interestingly, there's no voice. I think that the Fed and Yellen have decided to turn quantitative tightening into sort of this self-fulfilling prophecy by just letting it happen itself. Is what will have the power, because that will eventually, well, it needs to happen. The Fed needs to get out of the game of manipulating asset prices. I know I'm stating the obvious here, but particularly in the mortgage-backed security market. I mean, here you have on a median basis, record high home prices and rents that are going up 4 to 5% a year, and the Fed is sitting there buying mortgage-backed securities. So it needs to happen. But anybody who thinks that this reversal of Fed policy is going to lead to a soft landing, I think is delusional. This is going to end in an accident. It's just a matter of when that happens. So when you talk about the power, it's almost that the market now has taken over. As long as the Fed is willing to just let the balance sheet go, things will just happen until something breaks. The Fed will keep raising interest rates until something breaks, which is typically the pattern. And this pattern is not going to be any different.
It'll be crisis management instead of preemptive action.
Yeah, of course. And then a lot of that is because, the Fed delusionally believes in what they've done, and they don't see the unintended consequences of what they've done. But it'll be the market that will tell them, look at what you've done, and as they've done twice in the past 20 years. Okay.
In our last interview, you thought the fuse for this thing to be lit would come out of Europe from Draghi. Obviously, the last ECB meeting doesn't look to me like he lit the fuse, and we were having a pullback occurring in Euro. Do you think that Draghi eventually is going to be the catalyst still? Or,
yeah, I do. I think, I mean, the European bond market is the epicenter of the epic bubble. And I think with some interesting things that have happened, at least the last couple of days. And even today, I wrote a note that said higher inflation in Eurozone is very underappreciated risk. So we know Draghi is cutting QE by half beginning in January. Well, anecdotally, I'm seeing inflationary pressures building up in Europe. And yesterday, the Eurozone services and manufacturing PMI from market. This is what market said. Inflationary pressures have meanwhile lifted higher, with price charges for goods and services rising at a rate not beaten for over 6 years. Some price rises merely reflect the pass-through of higher costs, but companies are also reporting stronger pricing power as demand conditions continue to improve, which suggests underlying inflationary pressures are becoming more ingrained. That was yesterday. So today, market has the statistic on German construction, and they write intense supply chain constraints contribute to sharp rise in input costs. The incidence of delivery delays was one of the greatest seen for over a decade, while purchase price inflation was pushed to a 6.5-year high. They also came out with their retail PMI today, in that it said gross margins facing Eurozone retailers continued to be squeezed at the start of the fourth quarter. Contributing to falling margins was another rise in average input prices. Moreover, the rate of inflation quickened to a 57-month high and remains substantially greater than the long-run series average. Yesterday, the CRB index, I don't know if people noticed, but the CRB index had its second biggest day in a year. The CRB index closed yesterday at the highest level since February.
Yeah.
So there's inflationary pressures that are building. Now, if you look at the German 10-year yielding 34 basis points, if you look at the reported CPI number, and if you look at the high-yield debt in Europe yielding 2%, you wouldn't think that. But if you just dig a little deeper and you see these anecdotal bits of information and you see commodity prices moving up, an unappreciated risk that no one is talking about is a quicker pace of increase in inflation in Europe, which would completely throw out Draghi off kilter, even with him cutting QE by 50%. So I see major issues with the European bond market next year that will filter over to bond markets around the world in the context of asset prices that we know are highly inflated, but have been for a while.
Could oil be part of the story, Peter? I mean, people have been bearish oil for a long time. We had that collapse a year and a half ago, and the charts are looking okay in oil, and there's some geo stuff happening in the Middle East right now.
Yeah, that will be part of it, no question about it. But you also have labor markets that are tightening around the world, even in Japan. Okay, so today, or September, Japan reported base pay, so regular pay, not including overtime, not including bonuses, rose 0.7 year-over-year. Now, it doesn't sound like much, but a 0.7 gain in regular pay matches the fastest increase in wages since March 2000. So maybe even Japan.
Yeah, even a demographic that's pretty negative, they're seeing wage pressure.
Yeah, and I bet you if you pulled a room of 100 people and saying, do you see inflation as a threat over the next 12 months, 90 of them would probably not raise their hand. So I think that is something that we should be paying attention to, because that would really throw everything off base. And you talk about who's the power in the Fed. Well, if this inflation talk starts to percolate, particularly overseas, well, then the market will be the power that takes away some of the ammunition from central banks.
So the bond vigilantes will make a reappearance. I've noticed the bonds, really, you could say that they topped 2 years ago. They're not making a lot of downside progress or upper moves in yields.
Yeah, no, not yet at all.
Yeah. So do you think we'll get through 265? That was kind of like PIMCO's, or the old PIMCO, Bill Gross saying over 265 in the 10-year is kind of going to be the catalyst for sharply higher rates and a repricing of asset classes based on rates and PE?
I think if the German 10-year bund yield gets to 1% again, then there's a very high likelihood. And we have to remember, in 2015, in the summer, the German 10-year got as low as 6 basis points intraday. 1 month later, it was 60 basis points. A month later after that, it was 100 basis points. So risk happens fast. And if what I mentioned in European inflation starts to show up in the statistics, risk can happen very fast in yields there, considering the extent of that bubble. Now, on the other hand, we have the Fed that's raising short-term interest rates, and we're seeing 10-year highs in 2-year note yields. And that is going to be an inherent flattener of the U.S. yield curve, because it's paid to flatten the yield curve in the previous rate hike cycles because we know they typically end in a recession. So it is going to be a tug of war in U.S. long end yields between getting dragged higher by potentially higher interest rates overseas, but then the threat of Fed hikes in the short end, flattening the curve, pulling it down again because people are worried about the growth implications of monetary tightening here.
Yeah, people are poo-pooing the flattening of the yield curve, saying that's more of technical reasons. Do you think there's a shot if the Fed tightens in December and then keeps moving next year of it inverting? Or will they step in and not
very
let
much
that
a
happen?
high possibility because this typically ends in recession. The last 13 rate hike cycles put us into a recession, and considering how dramatic this accommodation has been, why wouldn't this one put us into recession too? Especially in the 9th year of an expansion, when most expansions last 7 years, 6 or 7 years. So that's
right.
likely to happen. Now we don't need a reversion here though, because the yield curve is still so distorted by monetary policy that you don't need a reversion to tell you that something's amiss. In December, a month after the election, when everyone was excited about Trumponomics, the 2-10 spread was 135 basis points. Today, it's barely above 70. Now, it's not close to an inversion, but if you don't take a message from that, then I don't know what you're looking at.
Okay, Peter, last time we were on, you have a long-term bearish view in the dollar, and you were right. I mean, the euro had one heck of a move from the last time we spoke, peaking a little bit above 120. I'm assuming that you're looking at this pullback in euro as being potentially a great buying opportunity. Where is your head at on the euro and the dollar? This is a bear market rally in the dollar because some wave people think there could be a blow off in the dollar to new highs.
I think just as in the beginning of the year, the dollar bull case was hugely crowded. A month ago, the dollar bear case got extremely crowded, and Draghi reminded everybody a couple of weeks ago how slow he's going to be going in reversing policy. So that was enough to see this knee-jerk dollar bounce. But I'm not a fan of the dollar. I acknowledge this counter-trend rally. It could last. Maybe the euro continues to sell off here, but I'm a bear in the dollar across a variety of currencies. But again, acknowledging that it could further bounce here, no question, as the Fed, tightens again in December, and we don't get another rate hike from the Bank of England, and maybe the Bank of Canada is done for now. But because of the economic worries that I have with the U.S. economy in this tightening, that will eventually be dollar bearish again. I mean, people understand that we don't have economic cycles anymore. We have credit cycles, and here you have the Fed tightening monetary policy in a credit cycle-driven economy. It seems to me obvious where this ends up, but I still think there's this belief that Trumponomics and tax reform and can somehow bypass the tightening of monetary policy. That worked in 2017 because we also had massive money printing out of the Bank of Japan and the ECB. But I think, unfortunately, 2018, it'll be monetary policy that eventually wins out in terms of its impact on economic activity and the cost of capital.
What an enlightening conversation, Peter. I have your website up here. Is there any feed for people to subscribe to your book report?
Yeah, they can go to bookreport.com, BOOCK report.com, and they can sign up for a free trial. They can sign up per month. They can sign up per year.
There you are.
Yeah.
Okay. I encourage people to check it out because you're one of the few people that when I have CNBC on, Peter, I turn up the volume.
Thank you very much. I appreciate that.
And I love the name, Book Report. I remember when I was younger and I didn't do my homework, I would say that my dog ate my book report. But this is really something, you really are a great Fed watcher, and your views have been lonely. Are you starting to be less lonely with 2018 rolling around, where every bear has really gone into hibernation? But you think 2018 still lonely?
It's still pretty lonely. I mean, I know 2018 is when it will start to matter, particularly just in January of 2018. I mean, the just look at the ECB and the Fed, the monthly purchases, if you net out the two of them, are going to go from about 60 billion a month down to 15 billion a month. On a 12-month run rate, you're talking about $500 billion of money, of less money getting pumped into the markets or the financial system. So it really begins in January, and I would not be surprised, similar to the response in January, February 2016 after the Fed raised interest rates in December 2015. We saw that big sell in the first 2 months of 2016, that we get a similar replay. I mean, the market's obviously doing what it's going to do this year, and it'll probably continue to next year, but the liquidity spigot turns into more of a drip come January. And I have to believe it's going to matter.
Yeah, the last time it disproved the theory, so as January goes, so goes the rest of the year. Maybe this time it's different. I know it's outside your bailiwick, Peter, but are there any kind of geo things that, a lot of things that are happening, perhaps what's happening politically with Mueller, perhaps what's happening with decertifying the nuclear deal with Iran? And, I look at the first thing that President Trump did was go to Saudi Arabia and then Israel and then decertify the nuclear deal. Do you take any of these things into account, that sometimes these economic cycles coincide with geopolitical cycles? And is that just something that is on, the outside of the way you look at things?
I think it's more on the outside. I mean, everything you mentioned is certainly hugely important, but I think at the end of the day, markets are going to be driven by the economic fundamentals and monetary policy. So if those geopolitics impact the economy, impact monetary policy, then it will matter. But if it does not, the markets don't care for more than a couple of days. And I think it'll be the Fed further tightening. It'll be the ECB dealing with getting out of QE. Even the Bank of Japan, I mean, they're in a subtle tapers. They're buying less ETFs. They're buying less bonds. To me, that's going to be the biggest driver, more so than geopolitics, assuming with Mueller, for example, only if it affects tax reform will it matter, but it's unlikely to. So it's news, but I don't necessarily think it's market moving news.
All right. Great interview, Peter. Once again, thank you so much for coming back. And people could follow you at Boockvar, and that's spelled BOOCKVAR. And everyone take a look at the book report. Thanks again, Peter, for being with us. And let's get back together. Yeah, let's get back together in 2018 and see what's happening as the water begins to only drip out of the spigot.
Sounds good.
All right, Peter. Thank you very much. Bye-bye. And F.A.C.E, that's it. Have a great day. We'll see everyone tomorrow. Good hunting the rest of the day. And remember, don't just count your pips, count your blessings, and get prepared for what Peter's talking about in 2018. It's only a few months away. You're very welcome, Luca. Okay, see you, buddy. So I'll see all my trading warrior brothers and sisters tomorrow. Enjoy the rest of your day. Remember, money comes and goes. Time is gone forever. Make it count. Adios. You're welcome, Kev.